Good morning. I'm trying out this new asynchronous mode of instruction so that people with connectivity issues can cope and everyone in class stays at the same level. In today's class, I'm covering a few concepts through this short video, after which we'll have live Q&A via Microsoft Teams and then an exercise to list down all costs. Those with connectivity issues can send their questions through text comments. In the last class, we saw that the top management of an organization delegates responsibility by creating cost centers, revenue centers, profit centers, or investment centers. We discussed examples of a textile company, a pharma company, an automobile manufacturer, and a projects-based company such as GE, respectively. The top management sets targets or budgets for each of the centers and monitors the performance against these. A robust system of management accounting is necessary for this control to be effective. Earlier, we talked about a typical cost sheet that divided costs into material, labor, overheads, and others. You might also recall the other basis of classification based on the relationship with output produced. This is called as the characterization of costs into fixed and variable. Fixed cost does not vary with output, whereas variable cost varies directly with output. Sometimes we also see terms like semi-fixed or semi-variable or mixed costs, all of which mean neither fixed nor variable. The line would look somewhat similar to this. An important aspect to remember here is that the characterization of costs into fixed or variable is determined over a range and are valid only over that relevant range. Let us try to understand this using a photocopier business. The business charges 1 rupee per copy and incurs 50 paise on paper, toner, electricity, etc. The capacity of one machine is 50 copies per minute and the fixed cost is about 10 rupees per minute. If the photocopying business is operating with one machine, then its fixed cost is 10 rupees per minute for the relevant range of 0 to 50 copies. The fixed cost would be different if the business operates with two machines or more than 50 copies per minute. The next basis of classification is traceability. Here we check whether the cost incurred can be traced to a particular unit of production. Consider a small town tailor stitching a shirt for you. Everything that goes into making the shirt is directly traceable to your shirt. This includes the cloth, buttons, thread, the time of the tailor in marking, cutting and stitching, any small miscellaneous work such as embroidery and so on. These traceable costs are known as direct costs. There may be some costs that may not be directly related to the stitching of your shirt. For instance, the amount spent on putting the name board, or the money spent on shop registration, or upkeep or repairs on sewing machine or the premises in which the tailor is operating. Since we cannot connect this money to your shirt or any individual garment stitched, we call them overheads or indirect costs. These days, most of us buy ready-made garments that are stitched on a mass scale in the outskirts of cities like Bangalore, Coimbatore, etc. Hundreds of workers are engaged in one factory and one observes a fine division of labor. If you pass different workstations, you will find a worker involved in marking the material using a template, and another involved in cutting, and a third on stitching just the sleeves, and another one putting the buttons, and so on. This is the direct labor. Then there may be some people involved in indirect activities such as making templates, preparing drawings, supervision of workers, preparing bills and other papers related to tax, compliance, payroll, etc. Many of them are clearly indirect costs, as they never even touch a piece of clothing that gets made in the factory. Over the decades, one can see that the share of indirect costs is increasing more and more, as the amount spent on automation, R&D, business modernization, advertising, litigation, etc. is increasing. A traditional business would have 10 to 15% indirect costs, whereas a modern automated business making the same product would have well over 50% in overheads.
If there are any questions, then we'll take them after everyone has finished watching this video. If you don't have any questions, then I would like you to proceed to this exercise. This will help you in clarifying any of the concepts that have been discussed so far. So it requires you to classify different costs happening at a vending machine, such as a coffee machine or other such machines you find in a college campus or a fast food joint or a mall or other places. So you need to list down the different costs that are occurring, then try to classify on the basis of their relationship with output. And then the same list of costs need to be divided into direct and indirect costs. Now, I feel that this exercise is better done if you work together in your groups that have been formed in this class. But even if you are not able to trace your group members, you can do it individually as well. And once sufficient number of people arrive at an answer, we will discuss this in class on Microsoft Teams. So all the best, and let us interact over Microsoft Teams now.